The dynamics of monetary forces on prices unfold as a fundamental principle of economics, rooted in the relationship between money supply and the goods and services for which money is exchanged. Every transaction involves these two elements, and understanding their interplay is crucial to deciphering how prices fluctuate over time. When the money supply increases, a basic supply and demand effect takes place. More money chasing the same amount of goods typically leads to higher prices. This phenomenon is straightforward on the monetary side of the equation, but the broader picture involves intricate interactions, particularly when considering non-monetary forces such as technological advancements, resource availability, and productivity improvements. Monetary expansion is often a deliberate tool used by governments and central banks to stimulate economic activity. When central banks increase the money supply, either through lowering interest rates or purchasing assets, the immediate result is a reduction in borrowing costs. Lower interest rates make loans more accessible, encouraging businesses to invest in capital projects and consumers to spend more. This initial surge in activity can fuel economic growth and elevate prices, particularly in sectors where demand rises faster than supply. For example, consider the extraction of commodities like oil or metals. Increased money supply and lower interest rates may prompt companies to invest in new mining operations or drilling sites. Over time, this results in an expanded supply of those commodities. In the short term, the demand driven by monetary expansion causes prices to rise, but as new supply enters the market due to investments in production, prices may stabilize or even fall. This is the essence of the non-monetary forces at play. Productivity and supply increases counteract the inflationary pressures of monetary expansion. However, this balancing act is not sustainable in the long run. Monetary forces tend to dominate as time progresses, particularly in systems reliant on fiat currencies, currencies not backed by tangible assets like gold or silver. As the money supply grows exponentially, it eventually outpaces the economy's ability to produce goods and services, leading to persistent inflation. This is a critical tipping point, where the cumulative effects of monetary expansion begin to erode the value of the currency itself. A vivid contemporary example is Turkey, where the government's relentless printing of money has caused the lira to depreciate sharply against stronger currencies like the US dollar. This devaluation triggers a vicious cycle. As the currency weakens, imports become more expensive, driving up costs for consumers and businesses. Meanwhile, attempts to stabilize the economy through further monetary interventions only exacerbate the problem. The system becomes trapped in a feedback loop, with more money needed to sustain previous levels of liquidity. This scenario highlights a critical flaw in fiat systems. They rely on continuous expansion to maintain stability, even as that very expansion undermines the currency's value. Non-monetary forces, such as increased capital investment and resource availability, can temporarily mitigate the inflationary effects of monetary expansion. When interest rates are low, businesses are incentivized to undertake large-scale projects, from infrastructure development to advancements in manufacturing. These projects lead to greater productivity and increased supply of goods, which can stabilize or reduce prices despite an expanding money supply. However, this dynamic is inherently limited by physical and logistical constraints. For instance, the time and resources required to mine new materials or build new factories mean that supply increases cannot keep pace with an exponentially growing money supply. Moreover, non-monetary forces are often hampered by diminishing returns. In resource extraction, for example, the most accessible and high-quality reserves are typically exploited first. As operations expand to harder-to-reach or lower-quality resources, the cost of production rises, and the capacity for supply increases diminishes. At this point, the inflationary pressures of monetary expansion overwhelm the deflationary effects of productivity gains, leading to rising prices across the board. The interplay between monetary and non-monetary forces has been starkly illustrated in historical episodes of hyperinflation. One of the most instructive examples is the hyperinflation experienced by Israel in the 1980s. At the time, the Israeli government relied heavily on its central bank to finance public deficits, leading to a rapid expansion of the money supply. Inflation spiraled out of control, and the economy teetered on the brink of collapse. The resolution came only after significant structural reforms, including a prohibition on direct central bank financing of government deficits and a reset of the currency system with the introduction of the new shekel. These measures restored confidence in the monetary system, but only after years of economic turmoil. A more recent example is the United Kingdom's response to the COVID-19 pandemic. The UK allowed its central bank to directly finance government spending, a move that effectively printed money to cover deficits. Coupled with generous furlough schemes and other support measures, this policy mirrored the actions that had led to hyperinflation in other contexts. While the UK has not yet experienced full-scale hyperinflation, the long-term consequences of these policies are beginning to manifest in rising inflation rates and economic instability. Some economists argue for a return to a gold standard as a solution to the instability of fiat currencies. Under a gold standard, currency values are tied to a fixed quantity of gold, providing a tangible anchor for the monetary system. However, implementing such a system today would require a monumental restructuring of the global economy. The transition would disrupt existing price structures, as was the case during the Great Depression, when the US government revalued gold from $21 to $35 per ounce. This move acknowledged the flaws in the existing monetary system, but also caused significant economic disruptions, including widespread unemployment and business closures. Reintroducing a gold standard in the modern era would be even more challenging, given the scale and complexity of today's global economy. The required adjustments to currency values and price levels would likely lead to severe economic contractions before any stability could be achieved. Moreover, the sheer volume of fiat currency in circulation today far exceeds the available gold reserves, making a direct transition impractical without significant devaluation of existing currencies. At the heart of these discussions lies the monetary regression principle, which asserts that all monetary systems must be rooted in historical precedents. Modern fiat currencies, such as the US dollar, originated as substitutes for commodity money like gold. This historical linkage provides the foundation for the value of fiat currencies, even as their connection to tangible assets has diminished over time. If this linkage is broken, if fiat currencies lose their perceived value, the entire system of pricing and trade collapses. This is why gold, despite its fluctuations in market price, retains its status as a monetary constant. Its value is not merely speculative, but is deeply embedded in the structure of the global economy. When fiat currencies experience hyperinflation, it is often perceived as gold rising in value. However, this is a misinterpretation. In reality, the apparent increase in gold prices reflects the devaluation of the currency in which it is priced. This distinction underscores the enduring role of gold as a benchmark for monetary stability, particularly in times of economic crisis. The reliance on fiat currencies creates a self-reinforcing cycle of monetary expansion. When central banks inject liquidity into the economy, they do so by purchasing assets, such as government bonds, with newly created money. This process increases the money supply and stimulates economic activity in the short term. However, when these bonds mature, the central bank must withdraw money from the economy to redeem them, creating a liquidity shortfall. To address this shortfall, more money is printed, perpetuating the cycle. Over time, This dynamic leads to an ever-expanding dependency on new liquidity. As more sectors of the economy become reliant on cheap credit and inflated asset prices, the ability to reverse course diminishes. Attempts to reduce the money supply or raise interest rates risk triggering deflationary crashes, forcing central banks to resume monetary expansion. This feedback loop is a defining feature of fiat currency systems and ultimately leads to their collapse. The interplay between monetary and non-monetary forces on prices reveals the inherent instability of fiat currency systems. While monetary expansion can stimulate economic growth and productivity gains, in the short term, its long-term effects are unsustainable. Historical examples, from Israel to Turkey to the UK, demonstrate the limitations of relying on fiat currencies, which are prone to cycles of inflation, devaluation, and eventual collapse. As the money supply grows exponentially, it inevitably undermines the value of the currency, erasing productivity gains and destabilizing the economy. Efforts to restore stability, whether through structural reforms or a return to commodity-backed currencies, face significant challenges. The complexities of modern economies, combined with the entrenched reliance on fiat systems, make such transitions fraught with risks and uncertainties. Nevertheless, understanding these dynamics is essential for navigating the challenges of the global financial system and preparing for the potential consequences of its eventual unraveling.